Bobby, what's your caffeine intake on a normal day?
I start the morning with 6 shots of espresso.
No, you don't. That's a lie.
No, it's
Is it
true.
a lie? Is it
No.
really?
Yeah, I do a double shot, then I immediately do another double shot, then I walk away as if I'm not going to have the other double shot, and then I turn around and I say, "Who the fuck am I kidding? I'm going to have the other
I
double
have
shot."
another shot. We're going to have
And
it
I
now.
walk back, which is why we have an espresso machine in the house as opposed to driving to go get espresso.
And not that either of us are old at all. As you've gotten older, have you required more caffeine?
The funny part about it is the more, as I've gotten older, the more heartburn I've gotten from caffeine.
Really?
So it's very similar. You remember that scene in Trading Places where the guys are in the bathroom, they're like, "How's the hypertension?" And they're drinking.
Yeah, they're drinking. Yeah.
So I'm drinking espresso, and then I'm immediately going for the Pepsid AC to calm the heartburn. It's caused.
So there's something funny about that scene. And I swear to God, this is true. We were in 8th grade, me and my friends were watching it. We didn't even know what that job was. My friends were all watching it together, and they were like, "That's going to be Jimmy. That's going to be Jimmy when he's older."
Stop it.
I swear to God, I wish I could have it on recording.
I struggled to understand how they sold and made money.
Yeah, I was
watching this movie. I mean,
I don't understand.
They sold, and then they bought the stuff back. So now they have a big thing of frozen concentrated orange juice. Why are you on the beach?
Yes, and now they're on the beach. But I wanted to be on the beach, so I had to do some further investigation.
I live on the beach, so fair enough.
Welcome back to the Trader's Edge podcast. Jim Urio, Bobby Artino, as always, and we are going to bring in our friend, managing director of Madison Ventures Plus, Mitch Roschelle. We are ready for you, Mitch. Mitch, can you add anything to the caffeine conversation first off?
Well, there's 3 things that were going through my mind. First of all, you guys must know the pharma industry. You've probably bought and sold pharma stock in life.
Yeah.
So Prevcid would be the product that I would recommend for you. I'm not a doctor. I just play one on podcast. The other thing is, as you were going through the Trading Places thing, all I could think of was, "It was the Dukes. It was the Dukes." That's like the greatest line in that movie when Eddie Murphy's getting choked and he's like, "It was the Dukes. It was the Dukes."
I used to make interns and new employees go home and watch Trading Places in the first week of their work. I swear to God, I really did, which I stand by it as a way to learn about our business.
Trivia question based on that, and I'll tell you guys at the end of the show if you don't know. What was the movie where these 2 homeless guys were given a wad of cash, and then afterwards they popped their heads up and he goes, "Mortimer, we're back," and he had a wad of cash and it was the Dukes. That were the homeless guys.
I do remember something about that, but I can't remember what it was.
Trivia question. Anybody knows?
No, I'm going to go with. Is it Ghostbusters?
No.
Come on, tell us now. It's going to drive me nuts. I'm not going to be able to bring my
anyone.
No
anyone knows it in the comments.
Googling.
I'm not Googling. I'm charting. But we need to know if anyone in the comments knows that. So
right, and I've been told that there are some people who tune into our podcast because they don't want to hear caffeine and movie trivia and actually want to talk about markets. I'm not certain this is true, but let's work off that as a principle here. Mitch, so we had our podcast yesterday with Luke Roman, our Futures Edge podcast, and I believe that what's happening in the long end of the yield curve is telling. It's the most important thing. I think last Wednesday when that bond auction, which didn't fail and it wasn't a disaster, but it was just a glimpse into people not wanting our paper, which means people think that perhaps we are spending too much and perhaps this second war is going to be a big deal and risk assets are going to suffer. Can you draw a line through that?
Well, yeah, I saw, believe it or not, I think it was Cushman & Wakefield of all places that, wasn't a Wall Street firm. It was a real estate services firm, had a really good research note that came out this morning that as I was walking Fred, my golden retriever, I was looking at it and I hadn't really looked at the movement in the yield curve in the way this graph depicted it. And I was like, oh my God, like it's not just inverted, it's like perverted. It's like crazy. So Jim, I would be with you and say bond traders know more about the economy than stock market traders do, or investors in equities don't know as much about the economy as investors in debt, specifically U.S. Treasuries. That said, the role of foreign central banks in our treasury auctions can't be really overlooked. So, every currency, every central bank that matters, whether it be the Bank of England, the Bank of Japan, or the Bank of China, they're trying to figure out how to balance their reserves overseas and, dare say, manipulate their currency. I love that be in that. So I don't know what role they're all playing in moving the yield a little bit, right? We do it as our central bank in the way we print money, but I think the other side of that trade is foreign central banks. But if they're not bidding for whatever reason, whatever geopolitical reasons there are, right? China holds $1 trillion, or pretty close to it, in U.S. Treasuries and other. So what are they doing? Are they potentially not buying U.S. Treasuries, but buying mortgage-backed securities because they want a little bit more yield? I don't know, right? So I think that plays a role in Treasuries, and specifically the longer end of the curve. So it's not just bond traders looking at the U.S. economy going, oh, shitstorm ahead. I think it's also foreign central banks.
Bobby?
Yeah. So from a perspective of that, when you look at the overall yield curve, what does it mean to you, Mitch, when you see the long end rising and the dollar not necessarily higher? The dollar's higher today, but there's been a couple of days where, I can even look at my spreadsheet. I don't have it up right now, where yields rose and the dollar fell, then rose, then fell, then rose. What do you think's going on in the longer end of the bond market? And do you think the Fed is being genuine when they say the longer end's going to do some of the work for them?
Well, if they wanted the longer end to do work for them, 4 years ago when Trump and Mnuchin talked about, kicking 30-year treasuries and making them 50-year treasuries like Ireland did, that would have been letting the yield curve do the work for you. Since we blew that, I think also what's happening when auctions go out, it's really a mixed bag of maturities that are being auctioned on a weekly basis. So there's also play in the secondary market on that at the same time that may offer a different alternative. But here's my macro view. My consulting firm is called Macro Trends Advisors, a little free plug in there. So I got to have a macro view. And I think we're in this weird place where debt and equity are priced wrong. And I'm going to talk about private equity for a second. So because I spend a lot of time in the alternative space. So you have a private equity deal you're taking out, and it's a cash flowing deal like real estate, like the kind of stuff I do for a living. We're offering preferred returns, cash flowing preferred returns, not hope certificates, cash flowing preferred returns to investors in the 8-9% range. Okay. Current pay 8-9%. Yet if we want to borrow money for that project to lever our position, we're paying 10%.
So
it's crazy.
Doesn't work.
Doesn't work. So, well, it actually does, because we're not over levering. We're doing like 65% loan to value. So it works. But when debt and equity, when the expectations for current pay for debt and equity are different, the difference is obviously equity enjoys appreciation and debt doesn't. If it's non-participating in debt, it doesn't. But just in terms of what I need right now to reward me for the risk that I have on the table now, when debt 10 and equity is at 8, that just doesn't make sense to me. So that's a long-winded macro answer to the question that something has to change in the yield curve because the risks and rewards aren't right.
Okay, so tell me this. What are you saying when we're talking about these high yields and the risk rewards? So equity, stocks, risk asset equities, like that is obviously is an unknown. You're not necessarily buying those for the dividends. So what you're saying when you're talking 8%, 10%, these numbers that are huge, does that have serious negative implications for the stock market itself to have to go back? If people's money can go and chase these high yields, whether you're the lender or the borrower, like you just said, does that mean we're heading lower?
No, I don't think publicly traded equities are traded lower because they have liquidity and the private capital markets don't have liquidity, right? You just can't sell that office building. Well, forget about office buildings, but you can't sell that apartment property tomorrow. You can't get repaid in a loan tomorrow. So definitely maturity premium are out there. But I just look at listen, the three of us have had conversations when we were talking about whether we were doing it together or we were all doing it on different shows at the exact same time. But we were talking about when the Treasury curve crossed over the S&P 500 dividend yield, right? That was something, because then the people were buying equities because they were paying a higher yield than debt was. So we're not talking about that. Yield on the S&P 500 is what, 100 and something basis points, and the 2-year Treasuries at 5 and change, like it's crazy. So we're not talking about that. But just when I think about how risk is priced, because you were asking about risk assets, I think somewhere in the middle of that question was when you look at the way risk is priced, it doesn't make sense relative to non-risk assets in some regard. So I think that there's some form of reckoning potentially in the high yield debt space. There's some day of reckoning in growth stocks. And I made this comment the other day on Charles Payne's show when the stock market rallied a bunch of days last week, and it's because interest rates were falling. And I said, wait a second, bond prices are supposed to go up when interest rates go down, not equity prices. Like there shouldn't be a negative correlation between equities, publicly traded equities, and interest rates. That you don't invest in that. You don't invest that way. You think the 60-40 asset allocation model was effed up. Like that's really effed up when that's happening, right? So I just think that there's a repricing, and I think we're seeing it. These growth stocks, these Divine Nines and Super 8s, they all sound like Callaway golf clubs, by the way. But in any event, the Great Big Bertha, when I put those aside, the rest of the stock market is really underwhelming from a performance perspective. And maybe that's because investors are looking at equities, publicly traded equities, and saying they're just not priced for the risk. Right. Healthcare. Yeah, healthcare had its day. Now oil's having its day. Defense stocks are going to have their day. But if you just look at sort of the S&P 500 and you pull out a handful of sectors or names, it's really underwhelming. Right? It's like run on a treadmill and not even racking up the miles. So I think that there is some reckoning beyond the already anemic pricing that's in 400 of the names in the S&P 500 probably.
So let me ask you, and I'm not even sure if you have insight on this, but based on the fact that you were talking,
I'll make it up if I don't. It's okay.
Yeah,
That's okay.
right. That's what we do.
That is the forum we have created. If you don't know it, please do make it up. Before the earnings season began, they were talking about somewhere in the range of 7% growth in sort of the massive banks, right? The multi-banks. And that's earnings growth. And then about negative 15% in the regionals, somewhere in the region of -7 to -15. So far, it's playing out that way, right? We're seeing some decent earnings from the major banks, and then some of the regionals are kind of struggling, not doing as well. Does that give you any sort of insight into, because loan loss provisions have been bigger and bigger, right? Does that give you any insight into commercial real estate at all? And the reason I ask this is I watched an interview with a prominent commercial real estate person in Texas and a guy like us, right? Mm-hmm. And he basically said commercial and residential real estate in Texas specifically is about to hit the apocalypse. But I also have a friend in Chicago who is buying up commercial real estate, and his view is, I'm going to be a billionaire or I'm going to be broke by the time this is all over. Do you fall on one side or the other of what's going on with commercial real estate?
I think the problem with commercial real estate is it's in this big basket and it's all lumped together and it's totally not the same, right? Mm-hmm. I'm going to go with the 5 food groups of commercial real estate, right? So you have apartments, you have office buildings, you have retail, you have warehouses, and then I'm going to throw hotels in, okay? All 5 of those are performing completely differently for different reasons. And if you lump them all together, you get hosed. Let's start with the top of the food chain as far as I'm concerned, which is multifamily apartments. I think that is the absolute best thing for real estate. And if you're investing in apartments right now and you know what you're doing, you're going to be fine. we have a home shortage in this country. Whether the housing starts number came out, it's still anemic. We're building probably 1 million less homes a year than we need. If you look at since the financial crisis, there's probably 3 to 5 million households that have been formed for which we haven't built new supply. So people got to live someplace, and forget about millennials living on their parents' couches. That's crap's not happening anymore. So we need apartments. And so demand outweighs supply. Rents are going to go up, period. Industrial, what's interesting about industrial is that's sort of the Amazon trade. We still haven't solved the last mile delivery conundrum. That can's been kicked down the road. There's tremendous demand for warehouses, but everybody building that stuff thinking Amazon's going to sign the lease. Amazon's not going to sign every lease, and not every e-retailer can afford to pay that kind of rent. So that's great. It's a great sub-asset class, but it's not the top of the food chain. I'll tell you, the bottom of the food chain, office buildings, period, end of story. Figure, I don't care what anybody says. Maybe if we just stop building them and the population grows enough, we'll grow into the crap that we have. We have too much of it. People working from home, and that's all over. That's done. That ship has sailed. Meaningful fraction of people's workforce are going to work from home or work remote or work remote part-time. That's the truth. Retail is really interesting. Listen, I've been on television for 15 years talking about this, and the apocalypse in retail still hasn't happened. They've survived everything. They're like cockroaches in New York City apartments. Like nothing can kill them. So if they've survived all this, they're going to survive it all. So retail's fine. Just be careful investing in it. Hotels, to me, are the coolest thing because demand exceeds supply. And of all of the other 4 real estate asset classes, you don't get to price your product on a minute-by-minute basis. So if demand exceeds supply right then in that minute, you can add $150 to your room rate and get away with it, right? So hospitality is very interesting. So I'd put multifamily, industrial, retail, and then office. So in answer to your question, if you're investing in office, you're probably going to get hosed. I don't care what cents on the dollar you buy it at. If you invest in apartments, over time, you're going to do great. And the problem is the risk isn't proportionate in terms of what it's priced at. And the other problem is you talked about, Bobby, you talked about in regional banks, they're not lending money, period. They're just not lending money. So real estate is commercial real estate is a capital intensive asset class. And if nobody's lending money, the wheels just come. It's like a train pulling into the station. It just that squeaking sound. That's what's going on in terms of the capital flows in commercial real estate.
So a follow-up to that, Mitch, you're talking about liking hotels the most out of those, but I just pulled up a couple of stocks really quick because obviously most people that are watching this aren't going to run out and buy a hotel.
They're going to buy Hilton. They're going to buy Marriott. Yeah, exactly.
Yeah, I'm looking at Marriott, which is doing really well. Hilton's doing really well. Wynn is not. Is that more about where it is, like where their sort of energy is laid?
So most of those brands that you would buy, that's got a 3-letter or 4-letter ticker symbol or a CUSIP number, those that you're going to buy are really in the franchising business more than they're in the hotel ownership business.
Okay.
There are some real estate investment trusts out there that own hotels. I'm not a big fan of publicly traded REITs right now, only because people don't know how to price them, and there's not enough liquidity for that business to really make sense from an investor's perspective. I think the yields should be higher, and they're not. And so let's put REITs aside. But if you want to play in the hotel space as a retail investor, the brands are great because as that underlying hotel owner takes the rate from $300 to $500, that brand gets a percentage of that $500, right? So, and I know the CFOs of those brands, and they're former colleagues of mine from a past life, and they're doing great. And their only challenge for future growth isn't same store. Same store sales in the hotel business are doing great. Expansion of those brands in terms of their geographic footprint is the challenge because that's the underlying real estate business. And if that individual property owner can't get financing, they can't put more flags on new hotels.
So quick question to follow up on the hotel thing, because I think this is fascinating because I didn't know about the franchisees.
Yeah.
So when you're looking at the hotel industry in general, now, can you break it down? Business travelers, recreational travelers, and is that an easy way to do it? Like if someone in their mind thinks there's going to be an explosion in recreational vacation travel, what do they do versus someone who thinks there's going to be an explosion in business travel?
Well, so that's a pendulum that sometimes swings. Like we saw during COVID, the business travelers were gone, but hotels were filling up because it was recreational, because people just wanted to change the scenery, and they would stay in like a Marriott Residence Inn just because it had they didn't even care where it was. Like these were like almost staycations. There's not necessarily a trade-off between the two. The bigger brands, and I stick with Marriott and Hilton as the two sort of premier brands and the publicly traded companies that you could buy, they have done a phenomenal job of having assets across the entire what's referred to as chain scale. So from the Ritz-Carlton brand in Marriott, from the Waldorf Astoria brand that's in Hilton, all the way down to the Hilton Garden Inn or the Fairfield Inn in Marriott. So they've managed to spread their risk and growth across all of those brands so that if you're an investor and one's hot but the other one isn't, there's still revenue coming in the door at Hilton or Marriott, regardless. When do they suffer? They suffer when you shut down the entire economy. And absent us doing,
imagine that, right?
Right. Absent us doing something reckless like that again, I think that, and I'll give you a perfect example. Extended stay hotels is a brand. You've probably seen them all across America. I actually worked on that bankruptcy when they had filed bankruptcy. It was a leveraged buyout. The debt came due. The company filed Chapter 11. And we were monitoring cash because I represented the unsecured creditors, a group of secured creditors, excuse me, at the time. And every week we took in more cash than the previous week. I was like, I've never been around a bankrupt company where literally every week the cash we took in was more, because like it filed bankruptcy at the worst possible time. And when we really dug down into that business model, it was rebuilding after Katrina. It was like interesting things. It actually wasn't Katrina. It was another disaster in that part of the world. Now that I timestamp it in my brain, but like there's certain subsectors within lodging that are so unsexy that like retail investors may not be interested in it, but those brands now exist inside of those big brands, right? So if there is an infrastructure bill where we're rebuilding, trillions of dollars and we're rebuilding highways across America, those people working on those construction sites, they got to stay someplace. It's almost the reason why, if I were to make a correlation with another name, why you'd buy United Rentals after there was an act of nature catastrophe somewhere in America, right? Because they're going to have to rent generators. They're going to have to rent cherry pickers and stuff like that. Yeah, they're also going to have to stay in hotels while they're rebuilding that area. So that's what those big brands have done. They've just spread themselves out across so that you don't need somebody spending $1,500 for a hotel room night during Christmas break in the Caribbean. They're making money as a brand when somebody's spending $300 for a rundown extended stay kind of product in the same exact company, whether it be Marriott, Hilton, for example.
So I want to pivot to something, if I could. Jimmy mentioned that we recorded our podcast with Luke Grumman yesterday. And anybody who wants to check that out, it'll be released Monday. Both Jimmy and I will have it up on our Twitters. But he pointed something out to us that I thought was fascinating, and I want to get your take on it. Jimmy, I found the study. It was Hirschman Capital that Luke referred to. Since 1800, 51 of 52 countries with gross government debt greater than 130% of GDP have defaulted on their commitments. 51 of 52, so 98%. Either through restructuring, devaluation, high inflation, or outright default. Japan is the only example of a country avoiding default so far, despite having government debt greater than 130. Japan didn't solve their problems, but rather just mitigated it without defaulting. So 51 of 52 since 1800 defaulted. The US hit 130% in 2020. We're 124 and change as of today, according to that rolling debt clock that we can all log on to if we need to. What's your take on that, given that we're now looking to assist in funding for a second war? And I'm not, quick disclaimer here, I don't have the historical expertise to have an opinion on what's going on over there, and I'm not going to publicly have one. Don't want people to die, don't want to be involved in wars. Take that for what it means. What's your opinion on what could happen going forward with those rates we talked about? And is it possible for the U.S. to default?
Free market capitalism is the best pathway to prosperity. Isn't that what you're going to say? Isn't that what you're going to say at 4:00 today, Jimmy?
Yeah,
I actually mentioned it to Bob.
Larry
This
Kudlow,
question is for both of you. This question is for both of you, because I found that study and I read it after Luke mentioned it yesterday, and it blows your mind.
My only thought on the way out of there, and I only gave the Kudlow plug just because, every time I turn on, I see Jimmy's face. You're the only dude who doesn't wear a tie for Larry Kudlow, but that's besides the point. But
I used to dress up for him. He's Larry Kudlow, for God's sake.
If he's Larry Kudlow, for God's sakes. He's the only dude smoking cigarettes in front of 1211 Avenue in America still, too, by the way. But in any event, I think we have to grow the GDP. And because dealing that is like right now, we're looking at $1 trillion worth of debt service, like $1 trillion. Bob, you brought up defense, right? You brought up wars. You didn't bring up defense, but the defense budget is about to get ellipsed by the debt service budget. Okay. Yeah. So we got to do something, but the dysfunction in Washington right now on display. The only reason why it's not monopolizing the news cycle is because there's a war, okay, that's monopolizing the news cycle. Other than that, they'd be talking about, Jim Jordan failing his second vote. So I don't have a lot of confidence in Congress's ability to cut back spending. So if we can't cut back spending, the only solution to the problem, but I will answer your question. The only solution to the problem is that we find a way to grow more. I haven't looked at the GDP now, ticker for the third quarter, the Atlanta Feds, but they were looking at relatively robust growth. And then I saw the retail sales number the other day and I'm like, this consumer is on drugs. Like, what the hell are they doing buying stuff and sticking it on credit cards? So I'm almost more concerned about consumer debt than I am on our federal debt. But let's go to Japan to answer your question. Japan has been in the quantitative easing cycle for so long, it's like I can't even it's like there's nothing left to ease. Is it 40% of the Nikkei is owned by the central bank there?
Bank of Japan.
Jesus,
it's crazy. So modern monetary theory doesn't work. It's on display that it doesn't work. The first shoe to fall, and I kind of addressed it at the top, is going to be the devaluation of the U.S. dollar. And if that doesn't cause pause in Washington, I don't know what will. I don't see us ever defaulting. I think Japan's probably the best model for a shitty economy, but I don't see us defaulting. But it's got to be a wake-up call. And Matt Gaetz, as nuts as that dude is, he's like, fighting. He's a one-man dude fighting that fight. And the rest, it's not politically expedient for other people to wake up. Republicans can talk about it, but they're not doing a lot about it. And listen, it's a simple solution. We've got to pare back entitlement spending. That's the discretionary spending is just too small of a wedge of the pie. When debt service is $1 trillion in a $4 trillion plus budget, you cannot do anything back discretionary. You have to cut back the entitlement spending because you can't. The discretionary, you're not going to make enough room to cutting back discretionary spending.
So, Jimmy, follow up to you then. Can we grow enough? I mean, is the math there? Number one, and number two, Mitch just said devaluation of the dollar. So this argues for gold, right?
Oh, it certainly argues for gold, and I think this is all beginning, and I think this plays out over a long period of time. Like, we could easily kickstart GDP enough to grow our way out of it. Like, I live in Illinois and I have a restaurant that's, by relative standards, extremely successful. We sit on 2.5 acres and we only use about 2/3 of 1 acre. Everyone's like, well, why don't you, put over there? Why don't you have weddings over there? Because we take one shovelful of dirt out of those places, the taxes go through the roof, the regulatory people come in, and it's absolutely absurd. So I speak for Illinois, and that's just one example in Illinois of an environment that discourages expansion. So if we had a president, a Congress, and then you'd have to even go down to local taxing bodies who understand the point of business. So the potential is there for us to explode GDP enough to balance that back out again. We will not do it. Mitch mentioned cutting back entitlements, cutting back Social Security. Old people vote. They won't have the political balls to do that. I think they call it political will. I may have said that wrong. And my wife watches my podcast, and she says, you got to clean up your language, which no, I don't, by the way. I don't believe it's possible. And that's why I have a disproportionate allotment to gold, silver, platinum, and now Bitcoin, whatever the hell Bitcoin is, but it seems to be responding well to the badness that's going on in this debt to GDP ratio. So just to put a clear point on it, I was scared when I looked at the results of that auction in the 30-year going, shit, what happens if people really don't want our debt? So I'm kind of worried. I'm worried about risk assets, and I have a lot of gold. Does that answer?
Yeah, it does. And I mean, there's a solution we're not talking about, and nobody should ever talk about, and I hesitate to say it, but if we don't get some of this done, people need to die. And I mean, I'm not, I'm not pushing that.
You're not sounding like Bill Gates or anything, right?
No, I'm not pushing that as a solution. But if you want to really go down a rabbit hole, it makes Bill Gates kind of a hero.
Well,
anyway, I shouldn't say that. Somebody's
but on mortality for a second, the average age has kind of fallen as opposed to going up, which is weird.
All-cause mortality is through the roof.
The problem is, that's median or mean. Pick your statistical poison. The problem is the people on the other side of it, the older side of it, are getting much older, right? So the problem is the standard deviations have changed dramatically if you really totally look at that bell curve. Yes, maybe people are now dying 2 years earlier than they had been in the last 20 years, but there are a lot more people living to 90 than there were 20 years ago.
So maybe the solution to our problem is that shitty American diet of processed crap. Maybe this is going to be the panacea, not the bad thing. I am joking, people. I'm joking. Bobby, do you have another question?
Well, actually, to that point, I think I told you this before, but my wife and I recently started carnivore as an eating plan, and she shifted away from it already, but I love it. All my inflammation is gone. All my pain is gone. I'm able to work out more, heavier, harder. And the funny part about that, as if I'm not already that much stronger than Jimmy, the gap's widening, the strength gap, Jimmy, is
clearly widening.
But the funny thing about that to me is, from a perspective of this particular type of diet, somebody said to me, you're going to die of a heart attack. I'm like, great.
No.
I mean, I don't agree with that math. I've looked into the science personally, and I'm not a scientist or a doctor, but it seems to be more on the red. This is not what we should be talking about. But if I get to live a pain-free life for 15 years or a painful life for 30, I'll take 15 any day.
Yeah, but it doesn't work that way. If you're pain-free, you'll probably be living longer, right?
You would think, except I think I can do more things than I can. This has nothing to do with equities, Mitch. Can you
do a quarter pound curl though?
I can. It's the one thing I still allow myself is a little bit of brown liquor. But so again, back to markets then.
Yep.
When you look at commodities versus bonds, and let's take private equity out of it. Let's take real estate and all that out of it. And you look at the average person going, okay, cash, bonds, short-term bonds, commodities, stocks. Let's talk short to medium term, not 10 years from now. Where do you see the biggest risk, and where do you see the biggest opportunity?
If we go relatively short term, I think the biggest opportunity is treasuries. If you can buy a 6-month T-bill north of 5%, and make no decisions for the next 6 months and guarantee that you'll have all that principal at the end of 6 months, that's a trade that retail investors are doing and institutional investors are doing all day long, right? I don't have to decide anything. I'm not going to lose my job. I'm fine. Okay. If you go out longer and you look at 18 months to 3 years, let's say, then you're going to look at stocks and say, you know what? How many periods of 5 years, or, over the last 50, like you'll see all those statistics, and I'm gonna have some good years, I don't know, years, but got to be in it to win it. I think commodities are a tough one because they're more impacted by geopolitical risk than other asset classes. Case in point, oil. Case in point, grains when you had the Ukrainian war breakout. So there's swings all over the place. I talk to our collective friend Scott Shellady about it all the time. Like that's more his world, and he dresses better for that world than I do. I think that I love giving Scotty a shout out, but I think that world has got way more volatility in the next 5 years than stocks do and bonds do. I mean, listen, if you take maturity risk off the table and you can manage credit risk and you have some balance in your portfolio and you don't have a fixed income asset with longer than 5 years and you're trying to manage money with a 5-year term, you're going to have your principal back. You don't have any risk there. So I think that fixed income, treasuries, high quality corporates, some agency paper makes sense in a portfolio today where, 2 years ago, we may have not been talking that way. But I would leave commodities out of it because if I had to turn that portfolio into cash in the next 5 years, I think the biggest risk of getting kicked in the teeth is probably in commodities. If I were to just look at it.
Just to put a finer point, when you said, and this was a head nod before my question, you're talking about taking duration out of the question because of the volatility that might happen with principal and duration, and just getting your 6 month and then deciding. And I love that, by the way. So when you said stocks over maybe the next 5 to 10 years, do you think embedded in that thesis is that the Fed at some point in time is going to give a little relief? Are they going to look at that $1.2 trillion that needs to be spent on debt service from the federal government? They're going to be like, oh shit, we have to let rates go lower, and that's when stocks
They have to.
They have
to. And to say that the Fed is not political is ignorant. It's just ignorant. There's no independence in the Fed. Maybe there was once upon a time, but when I look at the way Janet Yellen behaves today and the things she says today, she didn't become political overnight. I'm sorry. Okay. And by the way, she started in the San Francisco's Fed. So if there's a Fed office that's political, it's probably the San Francisco Fed with, Pelosi.
They did a kick-ass job, though, regulating SVB. But anyway, for SVB.
They did a
phenomenal job.
But so if the Fed's political, and the three of us and people listening agree, they can put in the comments if they think I'm full of crap. But if we agree for purposes of my hypothesis that the Fed is political, then they're going to succumb to political will of whoever the 40th president is and whatever Congress is in charge at the time rates. And by the way, if you're running for president and you are an incumbent, why aren't you picking up the phone and calling Powell and saying, when are we starting to lower rates again? Because I need another talking point for a debate. Right. Yeah. I don't know that the president's capable of that conversation. I don't know that Yellen is, but somebody's getting a phone call. So it was Trump. He would tweet about it, or he would tweet social about it.
But if the tweets are mean, then we got to vote him out. It doesn't matter about policy because we're thin-skinned people. We earlier talked about banks, and Bobby, I'm going to ask you the question real quick, and then to you, Mitch. Is that I tweeted today, and nobody seemed to understand the tweet. It was just in quotation marks. It said, "What's in your hold to maturity corral?" And I was talking about banks, and the talk about Bank of America possibly having losses of $130 billion in there. And Bobby, you always talk about standard accounting principles. And it just amazes me that they don't have to declare those losses that are now at 35%. When you look at the banking industry, KRB, KBR, KBE, the ETFs are headed
Keith
south.
Briette Woods, KBW. Right? Yeah. KBW. Is that the one? Yeah.
KBW. So then, Mitch, so you've been watching them too. Let's start with you then. Is the banks look like death to me? Do you agree or no?
I wouldn't. I said on Charles's show last week, I wouldn't touch regional banks with a 10-foot pole. Here's what they're doing. You want to borrow money from us? You have to put deposits in our bank. What? If I had deposits, I wouldn't be borrowing money from you. Okay. So like, if that's they're giving out toasters again, like this sense. So I wouldn't touch regional banks. The one risk area that you didn't touch, and regional banks sort of play a little bit of a role in this, is the credit card industry. Like, now granted, these are all receivables that are hypothecated and repackaged and sold. So it's not like Visa, MasterCard are holding these assets on their books, but I am worried about that. And so if we have credit card defaults, I think we probably also have more small business loan defaults. They tend to go hand in hand. And who banks small business, but small community regional banks? So that's why I'm worried about that sector, because their strategy for growing the strategy for financing their business with deposits is idiotic. And they have a lot of risk probably. And they don't put up big reserves the way Jamie Dimon does. Like Jamie Dimon has a good quarter, he packs the reserves. Moynihan has a good quarter, packs the reserves. I don't think those small banks can afford to do that.
Yeah, I couldn't have said it better myself. I think even the money center banks, the larger banks, have some problems ahead simply because of what I think is going to happen with commercial real estate. And they're heavily invested in that. Retail banking deposits have been collapsing. Reverse repo has been collapsing, showing that there's less and less free capital in the system. So I hate bank stocks completely, like just as a sector. Now, that doesn't mean I know what I like. And, quite frankly, I mean, I'll tell you the trade I put it on October 13th is I bought gold, the futures. This is a trade. Okay. I have a lot of physical gold, but I bought gold futures and I bought a NASDAQ call spread at the same time, figuring that if I'm, screwed on my gold futures, NASDAQ's probably rallying. It's not a perfect hedge. It's just an idea. There's a possibility I could make on both or lose on both. But it's a short-term trade because I didn't want a one-to-one hedge, because then what am I doing, right? And certainly that is not, gold rallying is not going to be a good sign for banks either in the short to medium term. And I don't think this gold position, this is a gold trade, but my holding of physical gold is a position. And to me, it's a position for the next 10 years. And I don't want to be near banks right now until the yield curve actually stabilizes in the correct place. And we've entered the recession that I still think is coming if that happens.
So Mitch, you talked about real estate, and I loved the hierarchy that you gave. What other sectors? We looked at banks. To me, banks are like shit. I think that you said it could be the 1-2 punch. They could be holding these long-term bonds in their hold to maturity corral. Plus, when commercial real estate starts to crack, which Bobby's been saying a long time, I've been saying a shorter time, and Mitch is now saying the same thing. So what are the sectors that make sense? You said an aging population.
Yeah, I like healthcare. I like retail healthcare. The problem with Walgreens is that Walgreens has got the Boots Alliance, so they have the UK in there, and it's a completely different healthcare system. I love the retailification of healthcare. During COVID. I love it. And I think CVS is an interesting play in that regard. I like United Healthcare, because United Healthcare is getting into they're not just a payer, they're now a provider. They're buying basically medical, consolidated medical practices. So I like being both a payer and a provider. I like that space. I like defense. You can't have two wars going at the same time. And potentially, I don't like trading based upon the who's the front runner in a political, but the fact that Nikki Haley's stock is rising and she's a favorite of the military industrial complex, never sell the military industrial complex short in terms of their ability to create outcomes in general elections. They are a big player. I don't like pharma. Honestly, I like healthcare, but I don't like pharma. I think pharma's going to get kicked in the teeth if we relitigate COVID, and so I just think pharma is going to get kicked in the teeth. But I do like healthcare. I also like the Halliburtons of this world too. I
was going to ask about energy.
Yeah,
Good. Yeah.
I like Valero. I like Halliburton. I like, to some degree, ExxonMobil. We'll see what goes on with that acquisition that they're doing. I like energy. I don't see oil, with the disruption in the Middle East, falling below 80. The problem with oil above 80 is that's a profit point for Putin, right? I was going for a little alliteration there, so I should get some.
I like a profit point for Putin.
Point for
good.
Putin,
yeah,
right. But I think 70 to $75 is where Putin makes money. 70 above 70 is also when domestic oil fracking makes money in the United States too. So if you want to look at something longer term, look at the players. Something's got to break with domestic oil production. Like we have to do something there. Like that. I'm sorry. Like what our entire strategy of the existential threat being climate change doesn't look like it's selling to the American people right now. When you have war on television. So that's and by the way, if there was a monster and chips for just 1 second. Chips is going to be an interesting place to watch. I think chips are going to be a piñata, going to go with another P. Chips are going to be a political piñata, 2 Ps. I got 5 of them out
we
there.
only give credit for 3. I'm not giving credit for 2. That's easy. And you're better than that. Okay, go on.
Yeah. All right. No, but I do think chips, like what's going on with NVIDIA right now, I think there's going to be – I would just stay away from high flyers that get swept up into political
reckoning, so to speak, at some point.
I mean, chips are in a pretty political pickle.
Yeah. And Jimmy, it's your turn.
I got nothing. It
was really interesting to me to see that the administration is going to restrict NVIDIA's chip sales to China, and then NVIDIA comes on and says that's going to cause problems with domestic chip sales. And I see 1 or 2 problems there. Either NVIDIA is right or deliberately going to cause problems, or China is going to say, what the hell, and start causing problems for NVIDIA's
Taiwan for
NVIDIA's manufacture of chips.
Yeah.
Right. And it just gets scarier and scarier when you start playing this scenarios out. And to your point, Mitch, about energy, I mean, there's a lot of people out there parroting that this is a record energy production for the US, and that's true. But we're doing it with about 40% fewer rigs, which means that record energy production is going to fall off a cliff, because anyone who knows anything about crude oil production knows that shale rigs deliver the bulk of their production at the beginning of their life. So if we don't have
it's a reverse hockey stick. Yeah,
exactly.
Yeah.
It's a reverse hockey.
When I look at tech streams that I have with knucklehead friends who read the Atlantic and the Washington Post and the New York Times. I have some of those friends, but and then I'll listen.
We all do.
But when they throw these facts at me, like, but the United States produced more oil and gas last year, so what your talking points from Fox News are bullshit. I'm like, okay, do you understand anything, dude? You were the president of a bank. You should know more. Like, this is not about today. This is about the future. And these are long-lived assets. Like when we invest billions in energy exploration infrastructure, we're not expecting to see, the bubble in crude for years. It takes time. If we haven't invested meaningfully in exploration in the last 3 years, what do you think's going to be our oil production as a nation in 3 years, right? Like it's going to be abysmal. Right. So that's why, educated people. Well, if I've learned anything in the last week and a half, educated people are incredibly uneducated, right? And the lack of understanding of the geopolitics within Israel and their noisy neighbors is astounding. That's a world that I know really well, and I know the geopolitics. And I'll, Bobby, to your point earlier, I'll leave it off the show. Right? I'll throw it on somebody else's show. But the fact of the matter is, people just don't understand. And I think I'm older than you two guys, but I got my driver's license in 1977. And when I got my driver's license, all I wanted to do was drive. I couldn't because there were gas. Okay. So one of my first jobs, was my first decent job, making $3.25 an hour. That was real job at the time. I waited on gas lines for the boss's wife. That's what I did. I spent the entire day. I worked in a deli. The guy who owned the deli would give me one of the two Cadillacs, and I'd wait in a gas line for like 6 hours for the delivery, because it was an odd day and an even day. Okay, so I understand an oil embargo. I understand a hostage crisis. Because I grew up when I learning about politics. Yeah, hostages in Iran. Like I get it. I'm just amazed, and it's not an age thing. I'm just amazed at how ignorant so many people are. And these are investors. Like, these are people who could check the box that they're sophisticated investors. They could buy private placements because they could check the box, and they don't understand. So that's a thing, an apolitical thing that America needs to be educated on. Our lack of investment in oil exploration is the single biggest national security vulnerability that we have, right? Like,
Bobby,
period.
can you sometime in the next couple of weeks write a Substack and just go over all the numbers on that? And I just want to put it in people's faces. I want to throw it out there, because I get that bullshit all the time about, oh, but we're producing more, so ha. No, ha to you. This is not the way it works, like you just laid out.
No.
So, I mean,
yeah.
This is
crude
again
to
one of
100.
those. I'm sorry. One of those things that used to drive me crazy when I do interviews on non-Fox channels, and I'm not singing the praises of Fox either. I'm just saying, people would say, well, if the price goes down, they'll just turn the spigots off. It's not a faucet, man. It's years of exploration and then construction and then hiring. It's years of it before they actually produce, before the rigs actually produce. So you're still seeing, again, not a political statement, but you're still seeing remnants of Trump's drill baby drill coming out of the ground now. You're still seeing remnants of that because of how long it takes to process. And people, they're like, oh, we're producing more under Biden. I mean, it's just an asinine thing to say, because it's not, the president can only hinder crude oil production. The only way the president can help crude oil production is to get out of the way. It still doesn't mean production is going to go up, because it's about exploration, leases available, whether they find crude where they're exploring, and capital expenditure, which could be, it has cost of capital concerns in it as well. So there's a lot of things.
But cost of capital, which has tripled, cost of capital, which has tripled in that period of time, right? And Jimmy, to pull this back to what you said about your restaurant, okay? The regulatory environment and the empowerment of what Ramaswamy refers to as the fifth branch of government, or the fourth branch of government, maybe the fourth and fifth branch of government. That's the scary thing, because here's what no one knows about infrastructure bills and all this bipartisan, get 3 Republicans to vote for it and it's bipartisan like crap. The legislation is aspirational. The legislation lays out, this is what we want to do. Then we turn it over to the bureaucrats to write the regulations. I'll give you a case study in that. When tax policy is written, tax policy gets codified, not in the form of the code section in the Internal Revenue Code, but by the regulations that departments to back up, to explain how an opportunity zone really works. It took them like 3 years to write the OZ regs after the Tax Cuts Jobs Act. Okay. So, and it was infrastructure. There are regs that are written by the Buttigieg's Department of whatever the hell, transportation and political correctness. There's the Energy Department, the Jennifer Granholm, who doesn't know how how oil commodity prices work. Like all these knuckleheads in the cabinet that run, tens of thousand people organizations underneath them. Okay, write the regs. The regs for infrastructure projects, I kid you not, outline how many GLBTQ plus people need to be on a construction job site. I don't know if you've been near a construction job site in a while, but they're not exactly the GLBTQ friendly joints. Okay. And I know people who are executives in major international construction companies who aren't bidding on some of these things, and identify the subcontractors who fulfill the requirements outlined in the legislation. You want to know why you can't charge your Tesla when you drive all the way across the country? Because there aren't enough charging stations? Because the regs that outline charging stations have so many environmental restrictions on them that they'll never get done. Okay. Or the public utility that supplies power to that area doesn't have enough amps to actually run those charging stations. So that's the problem with Drill Baby Drill. I know I fell down I hate bureaucrats rabbit hole, but I'm just giving you talking points.
We welcome that here.
No, but you have a Cudlow hit in like 3 minutes. I just gave you some talking points.
We got to get out of here. Right? But one last thing about what you just said, though. Every month, a group of IDOT, Illinois Department of Transportation people meet at my restaurant, and I've become friendly with them. And they work for the bureaucracy, and they're like, "Oh, it's bullshit. We can't ever do our job. Like, we want to do any sort of construction on a road. It takes like a year to get permission to trim a tree or to cut down a tree." And they're like, "It's all bullshit." But we do got to get going. I got
a picture.
What kind of restaurant is it? It's got to be an Italian restaurant.
It's an old school Al Capone pub. It's upscale pub food now. You know, burgers, ribs. It's extremely popular. You are cordially invited.
It's really great.
If I make it to the People's Republic of Illinois, I'll let you know.
Oh my God!
Hey, real quick, I want I've got a screen share here that I want to put up because it's going to answer the. By the way, we're not going to do a regular trivia question. That just seems so hacky. But the screen share shows you what movie this is from. Let's see if you can.
I know I've seen the movie. I remember the scene.
Should pop up. Maybe I'm doing something wrong here. Hang on.
Did you try clapping?
There we go. Is it up?
More. Yeah.
Okay. Now I remember the scene.
It's Coming to America.
Oh,
Coming to America, of course.
That's Lorne Michaels and all those same people again who did the.
That makes sense.
The movie.
It had to be an Eddie Murphy movie. I don't know why it's Busters, but it had to be an Eddie Murphy. Yeah.
It's Coming to America when he had all those hundreds and he was giving up being a prince and he just gave him the money. But anyone who hasn't seen Trading Places, you need to see it.
Oh, no doubt about it. Sooner the better.
Spectacular movie.
Mitch, you're the best. Thank you so much for coming. This is awesome.
All right, boys. Really always good to see you. Thanks for having me. You bet.
Cheers, Mitch. Thanks.